So normally Tesla stock sells off even on good news. Well, today in after hours, some bad news came out for Tesla. Apparently, Tesla could be impacted by tariffs, but not in the way that you think. Because yes, it's true. Tesla sells US vehicles that they make in America. But apparently some components are almost impossible to source from America. And Tesla is worried that reciprocal tariffs from other countries could be slapped directly on Tesla, which is something I didn't think much about, but perhaps explains some of the additional egregious selling in Tesla stock. Now, we do have some positive developments, some confusing developments, if you will, in the ongoing trade war with Canada mostly, but also erupting with Europe in recent days. But unfortunately, this still does not make me bullish on our markets right now. And besides Tesla, I'm really not buying the dip in anything else. And I will specifically tell you why I am not buying the dip in anything else and why I'm still playing very defensively right now. This could actually make you a lot of money if you pay attention, if I'm right, and if ultimately the strategy is correct. So first things first, let's start with this bad news for Tesla. Tesla warns it could face retaliatory tariffs. Now, this was a letter sent to the White House. We have no idea who wrote it, but it did come from Tesla. It's weird that we don't know who wrote it. It was not signed, but it nonetheless came from Tesla. Tesla said it is important to ensure that the Trump administration's efforts to address trade issues, quote, do not inadvertently harm U.S. companies. It said it was eager to avoid retaliation of the type it faced in prior trade disputes, which resulted in increased tariffs on electric vehicles imported into countries subject to U.S. tariffs. Now, I'm kind of unaware of the Trump 1.0 trade war, specifically what it had to do with Tesla. I was investing in the markets at this time, but I don't recall Tesla's issues here. Maybe I was just ignorant to the fact then. So I asked Grok, and it says, in summary, Tesla was impacted by the Trump 1.0 trade war, facing higher cost and market challenges in 2018 and 2019 due to U.S. tariffs on Chinese parts and China's retaliatory tariffs on U.S. vehicles. However, its proactive response, building the Shanghai Gigafactory, turned a potential liability into a long-term advantage, stabilizing its position by 2020. The trade war tested Tesla's adaptability, and while it caused short-term pain, it didn't derail the company's growth trajectory. Instead, it arguably accelerated Tesla's globalization strategy, positioning it better for future disruptions. Continuing on with this, it says the automaker added that companies will, quote, benefit from a phased approach that enables them to prepare accordingly and ensure appropriate supply chain and compliance measures are taken. So Tesla's basically asking the White House, in simpler terms, if there can be a phased approach instead of just a blunt, 25% tariff being put on, cars coming out of Canada, for an example. If the administration could phase that out over the course of, I would imagine, like a couple of months, that would create less of a shock event. That's actually a positive if that happens. From a recession standpoint, we're going to talk about this more throughout the video. The U.S. economy really only goes into recessions when you have shock events. Because if something is small or gradual, the U.S. economy will adapt to it. But if something comes on aggressive and it's fast and there's no way to adjust, that's when you get recessions, right? Think of COVID, think of 2008, think of 2001. Those were all shock events. And those are recessions. I mean, now it's 2025. That was 25 years ago, right? So really in the last couple of decades, you've never just had a recession. You could argue that what is going on with the trade war is a shock event. You could argue that Doge is also a shock event. So I think there's still a lot of risk either way. I think to some extent the damage has been done. Consumer is already reacting. They're already slowing down. But if we could get some kind of phased approach, I think the markets may like that temporarily. It's unsure if we're going to get that, but it's coming from Tesla. Elon's close proximity to Trump kind of, I would say, has Wall Street excited, at least a little bit here in overnight trading or after hours. The SPY currently up around 0.5% at the time of recording this video. Now, Tesla did not immediately respond to a request for a comment, but they say, quote, "As a U.S. manufacturer and exporter, Tesla encourages USTR to consider the downstream impacts of certain proposed actions taken to address unfair trade policies," the EV maker said in the letter dated Tuesday. Autos Drive America, a trade group representing major foreign automakers including Toyota, Volkswagen, BMW, Honda, and Hyundai, warned USTR in separate comments that imposing broad-based tariffs will disrupt production at U.S. assembly plants, basically saying it's not going to be good for United States manufacturing if it happens abruptly, if it just gets slapped on and there's no phased approach. The group added, quote, "Automakers cannot shift their supply chains overnight, and cost increases will inevitably lead to some combination of higher consumer prices, fewer models offered to customers, and shut down U.S. production lines, leading to potential job losses across the supply chain." So it is kind of vague what consequences Tesla could see from this. They do say in this letter that just some parts they're not able to get in the United States. And I guess I missed that going through it the first time. It says here, Tesla warned that even with aggressive localization of the supply chain, quote, "certain parts and components are difficult or impossible to source within the United States." So again, we don't know exactly what kind of issue this would cause, but it does look like Tesla is saying we're going to have a problem as well if you just slap these tariffs on overnight. And I mean, really, they've already had a month or two to fix their problems. Trump said as he extended the 25% tariff deadline another month, he said, "Don't even ask me to extend it again." So we'll see. I know Trump says a lot of things and then other things happen, but it's a very developing situation. I think the markets do like it, though, that Tesla is essentially asking for a phased approach because of Elon's proximity with Trump. But I wouldn't be so sure that that's actually going to happen, but we'll see. Now, also in the news today, at about 6 p.m., Trump says that he's avoiding a trade war. I'm as confused as you. It's just funny. Like, what? We're already in a trade war. The Premier of Ontario, Ford, said that the discussion with Commerce Secretary Lutnick was civil and positive. And Ford agrees to another meeting scheduled for next week. And the Ontario Premier says the temperature has dropped following this meeting. And he calls the meeting with Lutnick productive. Also boosting markets here in after hours, Schumer says that they will vote to advance the Republican stopgap bill. And the probability of a government shutdown decreases as Schumer backs ending the filibuster. Now, unfortunately, I mean, you would think the government staying open would be like a really positive catalyst, but it's typically a nothing burger. It typically is not really bullish or bearish. Historically, government shutdowns have actually been bullish. This time around, though, I think a government shutdown would be more negative because people would not get paid. Yes, there would be like a back pay or whatnot when people did get paid again, when the government did get funded, but it doesn't really change anything from that perspective. So sure, with markets down 10% from all-time highs, hitting a new low of this cycle today, with markets oversold quite dramatically, Could that be a positive catalyst this time around? Yes. But I wouldn't expect that to be a long-lasting catalyst. Now, the other thing about this correction that makes me a little nervous, why I'm not in a huge rush to buy the dip, this one is different. This one is like nothing you've seen since COVID, really. I mean, let's just be honest. This is the most aggressive, highest velocity, 10% sell-off we've seen since COVID, right? So from that perspective, from a velocity perspective, this is unique. It's also unique in the sense of you have not bounced. So you continue to sell off and you haven't gotten a strong bounce yet, like not a single strong bounce. But you've gotten these micro bounces, like from Tuesday, the low of the day on Tuesday, to the high of the day on Wednesday, 24-hour period, give or take. You rallied 2.3% from the low on Tuesday to the high on Wednesday, but it was immediately sold off today, and you're back to a new low in this correction. Really, no matter what the news flow is, people are selling the rips. Whether it's a 1%, just bottom to top move, 2%, doesn't matter. People are selling it with a velocity that you have not seen in a long time. Also, the technical disrespect of this rally has been something very unique. What I mean by that is your moving averages specifically. They've gotten no respect. Especially your 100-day, like we didn't give a crap about that. And that had really had a lot of respect, if you will, seeing a lot of bounces, support around that 100-day moving average, this orange line here, dating back to November of 2023. So well over a year, like almost 18 months, we were bouncing at this orange line almost every time. Now we're like 8% below that. No respect at all. But the 200-day moving average tends to be a bigger level, right? That tends to be where a lot of people initiate positions, buy the dip, sell if it's a bad setup. And there has been no respect around that 200-day moving average. The last time you were really below this 200-day moving average was in 2022, right? You were briefly below that in October of 2023, briefly, like 2-3 days, okay? You bounce right back up, business as usual. Within a month, you were at new all-time highs, okay? Last time you were really below this 200-day moving average was when you fell below it in January of 2022, okay? So from a technical perspective, this is really not being respected at all. You also have the VIX that shows a lot of complacency for the bulls, right? The bulls are not panicking yet. You're down 10% from all-time highs, and there's virtually no panic. Normally by now we see panic. Now, I don't know if that's because people are digging in for a, longer or larger correction period. That could be it. People are not as panicky right now. They're not all rushing out and going and buying protection like the VIX today. I mean, the VIX opened at 26.88 today. Or let's see. It opened at 24.92. It closed today at 24.66. Even though the S&P was down 1.3%, the VIX actually fell. Now, you have not seen a capitulation event yet for that to actually happen. Normally, that's kind of a bullish sign. And short term, could markets bounce? Of course. But you have not seen that flush out, that fear moment yet, which normally happens when you're at the bottom of corrections. It simply has not happened yet. And I'm not suggesting you have to see the VIX go from 20 to 60 in a single day, but to see the VIX close above 30, maybe 35, would be enough of probably a panic to actually mark a low, okay? So all of these things are different. When you look at the QQQ as well, that's where things just get even stranger because people do not want to hold tech. They don't want to buy tech. It's getting beat up, okay? Specifically, tech, yeah, Nasdaq, well below its 200-day moving average. But you're actually at your 300-day moving average. this white line here, 300-day moving average at $471.52. At the you closed at 468.34, so you closed below this moving average. Here in after hours, you're at 471.43. So you're like 8 cents, 9 cents below this moving average. So tomorrow is going to be critically important. If we fall below that 300-day moving average, well, last time that happened, you guessed it, was 2022. Okay, during the first real bear market rally that you had in March of 2022. And then you proceeded, once you fell below that 300-day moving average, you proceeded to fall 28%. Okay, so if that level's not respected, yeah, it's going to get nasty. And your next moving average that I like to watch is your 500-day moving average. That could set you back another 9% from here. And your 700-day moving average would set you back another almost 18% from here. I don't like that setup because what's the alternative? Things get a little bit better. Trade war, calms down a bit. We still have concerns about the economy and about growth and about a recession. That's not going to go away. What's the upside shot here? Nasdaq rallies 10% to the upside, gets back to where it was really trading December, January, early February, versus what? The downside? That could be, imagine if we go into recession, like back to your 2022 lows, you're looking at downside from here still on the Nasdaq of 46%. I don't like that setup, and I don't think a lot of Wall Street like that setup either. And I think that's why we're going to continue to sell the rips. Small rips, big rips if we get them. I don't think we're going to see a sustained market bottom until we get certainty on tariffs and certainty on the consumer and on the economy. Now, treasuries have been acting very weird recently. You can track this using TLT. I think one of the biggest surefire trades of this year is bonds. Trump, Scott Bessent, the White House themselves, they've all been adamant that they really don't care about the stock market. They want to see treasuries come down, treasury yields, because how the government funds itself is they roll debt into new treasuries, right? So let's say you have $1 billion of treasuries that expire, you get paid out. Well, what happens? The government doesn't necessarily write you a check. They issue you new treasuries, right? So from that perspective, which it is kind of like writing a check a little bit different. It's like rolling over a winning options, if you will. Well, when all of this debt is coming due this year, it's like $80 billion a month or something crazy in interest that is, I guess, the spread between where the debt was and the new issuance. So at these rates on bonds, we're paying substantially more per month on the debt that we have to issue. Okay, that's why they want to get treasury yields down, because as they do that day by day, it saves the government money. And that makes getting the budget, balanced a little bit easier. And it also helps Americans like afford a house again, afford a vehicle. And I was talking about this before the election. If treasury yields come down enough where real estate starts to sell again, that could actually be a positive surprise to the economy. So it's not all doom and gloom, but if you're weighing this on a risk reward, distribution, the downside looks more likely than the upside at this point. With that said, I do think that you are going to have a better opportunity to buy the dip. Again, if the S&P is down 20% from all-time highs, that is a better potential setup. Then I think you're at parity, right? Because if I imagine in a shallow recession, S&P could fall 40%, but if I imagine 613 is probably like a reasonable high for this year, if you're down 20%, you could fall another 20% from there, equal 40%, pretty straightforward math here, or you could bounce 20%. It's like a parity risk-reward ratio, right? Obviously, if you're a longer-term investor, things change, but in terms of your buying capital, I think down 20% when we get there. I don't think there's really a question. I think we will get there. How fast do we get there? How long do we stay there? I think those are the bigger questions, in my opinion. The risk reward starts to look better. Now, 20% down from all-time highs is going to put you almost exactly at your 500-day moving average on the SPY. Again, last time we broke below your 200-day moving average and actually stayed below there, you also broke below the 300-day moving average as well. The Nasdaq, or 500-day moving average, the Nasdaq's pretty much already there at your 300-day, and S&P's sitting right here just above its 300-day moving average. That's technically at 546. That is the next big danger zone to be watching. And then it sets you up for potential downside to your 500-day moving average of about 9 additional percent. So if we fall another 9% or so, in total, we'll be down 19%. That's when it looks a lot more attractive to buy the dip, in my opinion. That's when I think you're factoring in more of that potential risk of a recession. I don't think you're pricing in enough of that risk, and I think Wall Street's telling you that. And that's why there's a buyer's strike going on. People are not going out and buying the dip because we're too high. We're not priced for a recession. And it's kind of crazy because everyone seems to be caught off guard, right? Markets wouldn't have been this high if we knew what, Trump was going to do with trade policy and cause uncertainty and cause consumers to really pull back even further. Markets wouldn't have been that high to begin with. That's why we're not buying the dip on a 10% correction, because we shouldn't have been that high with the dynamics that we have with Trump. Just Trump kind of shocked everyone. Like, it was not priced in that we were going to have another trade war. Tomorrow, we will have some pretty important data as well that we will want to pay very close attention to. So, Michigan Consumer Sentiment Survey. Okay, you got your headline sentiment number. You're expecting 63.4. Last month was 64.7. You've been falling recently, but we've been lower before. So in July, you were at 66.4. And in previous times, like 2022, you were at 50. Like, people just felt really, really bad. Some of this I would expect has to do with the stock market, right? Before the pandemic, we were consistently in the 97 to 100 range. So, like, you're way lower than where you were pre-pandemic. Like, things had gotten a little bit better in 2023, 2024. Looks like you're starting to fall again. And we're expecting another fall from the headline reading tomorrow. Now, it's made up of many different things here. First and foremost, 5-year inflation expectations. Last month, this hit the highest level you've seen since 1995. It's very political. Democrats are skewing the numbers here, but it is something the Fed has acknowledged that they pay attention to. You're expecting that's going to rise from 3.5% to 3.6%. Any drop there is going to be fantastic news. Consumer expectations are expected to get a little bit better from 64 to 64.3. If expectations fall, that is probably the most important metric of this data tomorrow in terms of the economy, because just like inflation, if people expect inflation, they accept inflation, right? If you think prices are going to go up, you're more willing to pay them when they go up. Same is true with expectations. If you think things are going to get bad, well, you probably help create that, right? Because it's probably a sign you're spending less money, you're not doing as much in the business world, okay? So expectations kind of precede reality. So if that falls tomorrow, Wall Street's not going to like that from a growth perspective. Now, current conditions are expected to fall as well from 65.7 down to 65. So not a huge fall there is expected. Again, current conditions, another one that is important. And 1 year ahead inflation expectations are expected at 4.4%. Last month, they were at 4.3%. So you're expecting this to rise yet again. You've seen a big rise after, in February, a big rise after really the election. It's been going up for 3 months in a row. I don't think the markets care about this one as much, but it could be important. Oil and energy, gas prices have really fallen the last month or so. So I wouldn't be surprised if these expectations for inflation numbers 1 year and 5 year ahead do actually come down. That could be bullish for markets. Now, usually the Michigan Consumer Sentiment Survey is not a super important data point, but last month it really was. And I think with the nervousness around the economy, it could be again tomorrow morning. Now, again, with Tesla, I like the risk reward, position for the company. It's down 50+% from all-time highs. If we don't go into a recession, this thing's going to double or triple this year, in my opinion. If we did go into a shallow recession, the stock could fall like $100. So, big whoop, right? You have a lot more potential upside, in my opinion, from Tesla than downside. That was different when the stock was almost $500 per share in December, right? If we had went into a recession when the stock was $500, your downside is a lot more than the upside in that scenario. That has changed, right? You could have $100 of downside, call the stock down to $140. That could be reasonable in a shallow recession. Again, that would still be a drop from here of another 41%. So like, we're not talking small fries here. Like, we're talking peak to trough decline from 488 down to 140 as like 72% decline. That's basically what you've seen during 2022 for Tesla, right? Stock down like 75% and some change. That could happen if we go into recession. But if we don't, you could easily see the stock 600 to 800 by the end of this year. Morgan Stanley's bull case for Tesla this year is $800. That's going to put you up 236%. So in my opinion, how I'm looking at this, worst case scenario at this point, logically worst case scenario, anything can happen, but being logical here, you got another 40% downside. Better case scenario, you have 230% upside. I like that ratio much more than the SPY. In a best case scenario, you're going up 10, maybe 15% from here. 15% up from here in a best case scenario this year. It's going to put the SPY, in my opinion, around 635. Like best case scenario. If things were to get bad, you got like another 30-ish% downside from here. I don't like those ratios, right? Maybe 40% downside from here. I don't know. I don't like those ratios. Okay. But Tesla, I do. And that is why I've been buying Tesla. If you guys are in the trading community, you'll notice every now and again, I put out there, bought another 3 shares or bought another 5 shares. Because I don't know what's going to happen, but I do want to take advantage of where Tesla is today. But I'm not going all in right now. I'm spacing out my buys. As the stock falls 20, 30 bucks from my last buy, I buy some more. Okay? Because I want to be ready to put chunks in if the stock does get down to like 140. Some of these lower targets that I could see if we did go into some kind of recession. So, ladies and gentlemen, that is going to do it for this video. That's really what you need to know. Besides tomorrow's data, it's going to be slow overall. Want to watch what happens with bonds, clearly. That's kind of important right now. And to see if we can finally get a bounce. Tomorrow's Friday, though. People really have not wanted to hold over this weekend. So I'm not super optimistic. But again, anything's possible. And we're still waiting to see if the government is actually going to stay open or shut down. See how this vote works out later on today. That is going to go ahead and conclude this video, ladies and gentlemen. Hit that like button and subscribe to the channel if you have not done so already. Have a fantastic rest of your night, and I will see you in the next one.